amongst all this talk of taxation that we are being bombarded with in relation to the leadership campaign, corporation tax features quite heavily. Basically, will it be increased or will it not? The two candidates have different views on that. But in relation to corporation tax, you might get questions around, what if I were to invest money? How does that work from a corporation tax standpoint? Invest money that's in my company, says company owner. Just a quick reminder, I thought I'd just give you that reminder. There's a lot more detail on Techlink on this. The basics are in relation to interest generated from money on deposit, and the rates are going up gradually, of course, for rates on deposit, then the interest will be subject to corporation tax. If you made an investment in collective investments because you want to take a bit more risk and get a bit more, hopefully, return, then the dividends that are paid out or reinvested for you as a corporate investor will not be subject to corporation tax, provided the investment that you have is an equity-based investment, okay, not a fixed interest investment where the interest will be subject to tax. In relation to investment bonds, this is the big warning I wanted to get, and this is not new news, it is just a reminder. In relation to investment bonds, you think, well, I've got the tax deferment, haven't I? And the answer is yes, but only if the company elects for and adopts the historic basis of taxation. I won't go into the detail of that. Techlink does, and I would encourage you to give it a read if this is relevant to you. So in the few cases where you adopt a historic cost basis of taxation, then you do get the deferment of tax that you would expect with an investment bond, and tax is effectively deferred until you make an encashment. However, if you don't, and the majority of companies we think won't adopt an historic cost basis of accounting, won't be able to because they are not micro entity, which is the condition you need to fulfill to even be able to have the option to adopt an historic cost basis of taxation, then you will be caught by the loan relationship rules effectively when they apply to all companies, but in relation to companies that aren't micro entities adopting an historic cost basis of taxation, the loan relationship rules will effectively mean that you will, as the company, be taxed on the even unrealized increase in the value of the bond from year to year. So you will not then get the benefit of tax deferment. That's broadly how it works. So basically, not a micro entity, not adopting historic cost basis of taxation, loan relationship rules apply as they apply to all companies. The gains under the bond, even if not realized each year, will be subject to corporation tax as if realized. It all comes out in the wash at the end. From a cash flow tax planning standpoint, it does mean that you don't get the benefit of tax deferment in an investment bond. I would say, again, it's a relatively complex subject, especially the operation of the loan relationship rules, but it's covered in, I think, admirably clear detail in Techlink.